If you are a passive investor, note that there is 65% of probability that you completely ignore what I'm going to share with you in this video. And if you do ignore that, note that all the returns on investments that you might have achieved today from your passive investments are simply the results of bare chances. And in a world in which we live today, which is a world tormented by a series of crises, you're so close to lose all your returns on investments so far and even your initial capital. Well, in this video, I'll be sharing with you what professional passive investors do. Stay tuned. Hello, if you're watching me for the first time, my name is Arno, investor and serial entrepreneur in Germany and in Europe. Welcome to my channel, Wine Investor. Here we talk about investments and entrepreneurship in the wine industry, as well as other industries, while giving you methods and strategies that will help you achieve tremendous success in any business field. So like the video, share it as much as you can so that a high amount of people can benefit from my content just as you do. Subscribe and most importantly, activate the notification clock so as to always be on premier on all our videos. In terms of passive investments, an asset constitutes an entity in which you will want to invest your money and whose value is supposed to increase over time. Well, there are many classes of assets, and an asset class groups different assets that have pretty much the same risk to ROI ratio. ROI, return on investment. So assets which have pretty much the same risk to return on investment ratio. The first asset class I'm going to talk about here is the class of shares, the stock exchange market. Well, a share represents the part of a capital in a company. The first people to invest in shares, to buy shares in a company, are actually going to invest money which is going to be used to run the company. But time is going to give rise to a secondary market in which the shareholders in a particular company will want to sell their shares at profit in order to get out of the market. And this secondary market is actually responsible for the high volatility and the high risks you have in the stock exchange market, because the decision of a shareholder to sell his shares is pretty much going to be influenced by a lot of uncontrolled socio and geopolitical factors. Well, this is a class where you have a lot of risk, but this is also where you have pretty interesting return on investments. One of the very important things you have to note here is that in passive investments, the more you're ready to take a risk, the more return on investment you show with. The second asset class consists in dividends. A dividend is a sort of credit that you award to a company or a private fund over a predefined period of time, a period in which you're going to receive so-called interest on a regular basis, and at the end of which you're going to receive your initial capital back, or you might be, asked or invited to reinvest, your initial capital for a second cycle. One peculiar aspect about this sort of investment is that you have quite lower risks as compared to the stock exchange market, and that's why you should await here pretty much lower return on investments that you might have in the stock market. The third asset class I'm going to talk about is cash. Yes, you've understood me very well. Cash. Owning cash from a theoretical point of view could actually be a potential source of revenue. But that would be the case if we were living in a world in which deflation reigns. Deflation means money stuck somewhere just increases the value over time. But we live in a world where inflation reigns. Money stuck somewhere just decreases in value over time. And in the last 10 years, we have had an inflation rate of about 2.6% per year. And that's why more and more people are going to stop saving money in current accounts. And in case they don't know where and how to invest their money, might save the money, for example, in a savings account and get some minor return on investment from the bank, maybe after every term or after every year, depending on the country in which you live. A more popular way to do cash investments consists in investing in forex, foreign exchange. You use your cash to buy foreign currencies. Well, this is a quite stable market because the exchange rates between different currencies are certainly changing over time, but they are more or less stable. So this is a segment in which you have less risk and definitely lesser return on investments than what you're going to have, for example, in the stock exchange market. The fourth asset class is real estate. Yes, I know you were just waiting for that, and everyone is talking about real estate on every platform. Yes, this is because the value of real estate lies on a solid foundation, which is simply demography. The world population is evaluated today at about 7.9 billion inhabitants, and this figure has been increasing over the last years at the rate of about 1.5 to 1.7% each year. This means that if we take into consideration that in every apartment, in every home we have a maximum of 5 people, we definitely need to build the world over about 27 million homes every year, which is quite not easy in terms of, time is limited. If you want to do good buildings and solid foundation, you need a great amount of time. This is not possible. So, which means that the existing, real estate are going to increase in value because the demand is getting higher and higher. Generally, the investments in the real estate sector simply consist in making use of a lever effect by means of mortgages that are granted from banks. Over these banks, however, sits a central bank, and this bank has the power to dictate the volume of mortgages as well as the rate of interest that the banks are going to grant to end consumers. And that's where the game is being played. The central bank, by changing these values, are simply going to affect the number of people who are interested, for example, in getting a mortgage to construct, for example, a new building or to buy an existing real estate. And this is definitely going to affect the demand rate on the market, which definitely has an impact on the price of a real estate. So you might have prices falling at a particular time as well as increasing at a particular time. One second peculiar aspect here is that other crises can have a tremendous impact on the value of a real estate. If you look at what is happening today, for example, the crisis between Russia and Ukraine, this war has affected the availability of a lot of raw materials on the markets in many sectors, and especially in the construction sector in Europe. This means that a lot of materials are going to increase in value. The construction in general is going to rapidly increase in value, so more and more people are going to go away from constructing new real estate depending on the market. It's not the case in everywhere in the world, but however, this is going to increase the demand of existing real estates and therefore have a tremendous increase in price. However, if the banks, as the case might be, for example, in many places in the world right now, decide to increase the rate of interest on mortgages drastically, this can increase in a rapid fall in the price of real estate. What I want you to understand here is that, of course, the value of real estate lies on a solid foundation, which is demography. But the prices of the real estate can be subjected to a drastic fall. And we're talking here about investment in terms of hundreds of thousands of euros. So a decrease in 10% is a lot of money. The fifth asset class I'm going to talk about is the class of commodities. Well, commodities are simply raw materials which you use to manufacture end products. If we talk in terms of precious metals, you have aluminium, you have copper, but in the agro sector, you have, for example, wheat. Okay, we're talking here about a sector in which you have almost no significant risk. Yes, you might have fluctuations here and there, but in the mid and long term, you have an increase in value, simply because we are living in a world where the consuming habits are getting more and more aggressive. 10 to 15 years ago, you would be happy, for example, to have a phone and use a phone for 3-4 years. But nowadays, every 2 years, every 1.5 years, you're changing phones. So the consumers are getting more and more aggressive. Secondly, the population is increasing, with time. Like I said, we have an increase in the population of about 1.7% each year, which means we have more and more people who are consuming. Well, the first mistake I see a lot of passive investors do is that they will invest, in a particular sector simply because they have seen other people investing in that sector. Very fatal error. Well, what you have to note here is that the proportions of your capital dedicated to passive investments, which you're going to invest in the different asset classes, are pretty much going to depend on your age. For example, you will invest at maximum, in the stock exchange market, a proportion of your capital which is equivalent, to the subtraction of your age from 100. If you're 50 years old, you have to invest maximum 50% of your capital dedicated to passive investments in the stock exchange market. If I have 20,000 euros that I want to invest, I want to invest as passive investment, I will invest a maximum 10,000 euros in the stock exchange market. But I see a lot of people who are 55 years old, 60 years old, who hear from young people who have invested, I don't know, 50, 60% of your capital dedicated to passive investment. For example, in the stock exchange market, they will tell you, I invested in Tesla, I invested in Apple, and they just do the same. You need to know that the more you grow old, the more you have to refrain from, investments with high risk and investments which demand a high amount of time, to pay in value. The stock exchange market is a market which has a high risk. I'm talking here about passive investors, people who want to put in money and allow this money to work for themselves. All right. There are, of course, active investors who, get up in the morning, they buy shares, they buy, shares in the stock exchange market with the aim of selling it throughout the day, or maybe the next morning. It's just a matter of timing. But if you are a passive investor, you want to invest your money somewhere and want it to work for you and bring you returns over time automatically, the stock exchange market is meant for people who are willing to wait for 10 years on average, more or less. So get it, the more you are old, the more you should refrain from such investment. The more you get old, the more you should go towards dividends for a shorter period of times. You can invest, for example, in the current foreign forex market, buy currencies here and there. Very important. That's what we call asset allocation. That's why you will see a lot of people investing in the sixth asset class, which is hedge funds. Hedge funds, investing in hedge funds simply means investing your money, putting your money in a fund which is going to be managed by experts, and the first thing these experts do is to put, into place a strategy, an asset allocation strategy that will help them allocate, percentages of the fund or the capital in the fund to different asset classes. Most of them are going to, invest or on a short or mid-term range in the stock exchange market, because you can make high rate returns on investment in these markets with high risk, of course, but that's what it's all about. So you make high risk, high return on investments, and you have, customers who also are waiting for, a certain amount of investment because, they are not ready to take the risk. So you have to guarantee them a certain return on investment at a lower value than what you are going to get for the same amount of money in the stock exchange market. And that's how the hedge funds, they make their money. Well, I think you've understood, the more you get old, the more you should refrain from risk-intensive asset classes. The second mistake, a fatal mistake I see a lot of passive investors do, is that in the aim of mitigating the risks by investing in different asset classes, they're going to invest in asset classes that are more or less highly correlated with each other. What do I mean by this? By the end of 2020, the Citibank, which is a private bank in the United States, published a document showing correlations between different asset classes which are well known all over the world. And this document showed figures between -1 and 1. A correlation of 1 between two asset classes simply means that if in one asset class I have an increase in value of 10%, in the other class I definitely have an increase in the same amount, 10%. A correlation of -1 simply means an increase in the value of 10% in an asset class will have a decrease by 10% in the value in the other asset class. I think at this point you are getting an important message. As a passive investor, you will definitely attack, asset classes that have great returns on investment, but which are also related to high risk. So you're going to try to, mitigate this risk by investing in other classes, so you're putting your eggs in different baskets. But this is exactly where you need an important strategy that's going to avoid you putting certainly eggs in different baskets, but putting them in baskets that are all attached to one rope. Because if you just cut that rope, you're destroying all the eggs at the same time. So you're pretty trying to invest in classes in such a way that a fall or a loss in a particular asset class, is not going to affect, automatically a loss in other asset classes in which you've invested. Very important. This same document of the Citibank showed that you have a correlation of 63%, 0.63 between the stock exchange market and the real estate market. If you want to make it even very simple, let's just assume 50% or 0.5 correlation. This means if you have a fall, in the stock exchange market of about 50%, in the real estate market, depending on the country in which you live or which you are, analyzing, you will have a fall, in the real estate market of at least 25%. This same document also showed a correlation of 80%, so 0.8 between the stock exchange market and hedge funds. Like I said before, most of the hedge funds, they invest massively in the stock market. Well, what I want you to know is that if you have made a substantial amount of return on investment, for example, in the stock exchange market, and you want to, place this return on investment in other asset classes so as to, mitigate the risk. Let me say, if you are trying to invest, for that matter, in the real estate market, you're pretty much not far away from losing a lot of money, because the real estate market is also correlated, with the stock exchange. So if you still have in the stock exchange market a high amount of capital there, and you have a problem in the stock exchange market and you lose your money by, let's say, 50%, the money you've also invested in the real estate market is also going to, decrease the value. And in the real estate market, we're talking about investment in terms of hundreds of thousands of dollars and euros. Very, very, very important. That is why you have to invest in other classes that are more or less, not coupled with this conventional, asset classes we have. And that brings me to the seventh asset class, fine art. This very same document from the Citibank showed that we have a correlation of 0.13, so 13% between the stock exchange market and the fine art market. You have a correlation of 5%, so 0.05 between the hedge funds and fine art market. And you have also a correlation of 2%, 0.02 between the fine art market and the real estate sector. So you see that we have here a sector, or an asset class which is, or an alternative market class which is simply, separated, more or less separated from the conventional, passive market, stock exchange market and other passive investments possibilities. I'm not asking you here to take all the money you have in the stock exchange market to invest in the fine art market, or to take all the money you intended to invest in the real estate to invest in the fine art market. Because what you have to understand is that correlation also implies reciprocity. If a significant, drop in value, for example, in the stock exchange market, would have no significant impact in the fine art market, as it will have, for example, in the real estate market. Note that if you lose in the fine art market, for example, 70% in value, this will have almost no significant impact in the money you have in the stock exchange market. But let's look at this fine art market more in detail. This very same document from the Citibank showed that different types of fine assets had a high correlation with each other between 0.7 and 0.9, so between 70 and 90%. This shows that there is a peculiar factor that brings all fine art assets together. This factor represents the set of fortunate people. We're talking here about people rich in terms of millions and billions of dollars. And one important aspect here is that the number of millionaires and billionaires in dollars all over the world keeps on increasing. We've had an increase in this number with a rate of 11% on average in the last 6 to 7 years per year, 11% per year. And this number is set to increase. This rate is supposed to increase in the next 5 to 6 years to come. This means that if you invest in valuable objects, in fine art objects that get rare and rare as time goes by, you're going to have their values increase exponentially. Simply because over time, you also have more and more people who want to lay their hands on these objects. And they are ready to pay whatever amount of money they want to pay, to lay their hands on these objects, because they have the money. They are fortunate people. I have told you in one of my last videos that I invested in the fine wine, industry, which is also fine art. and I achieved 175% return on investment in just 4.5 years' time. Net investment passively. Well, let's take a closer look at this. If we take, for example, the year 2020 and compare what happened, in the conventional stock exchange market, we're talking about the DAX index, the FTSE index, Financial Times Stock Exchange, S&P, with what happened in the fine wine market. We'll be talking here about the LiveX Fine Wine 100, which is an index which represents the 100 most traded fine wines in the world. You will see that when we had a drastic fall in the stock exchange, conventional stock exchange market, in almost all conventional stock exchange markets around in the first term of the year, we had just a very slight fall, in the fine wine index, which confirms eventually this correlation of only 0.13 between both asset classes. Furthermore, if we look on that very same year, you will see that when we had a drastic fall, in the stock exchange market at a later point in time, we had an increase, in the fine wine index. If we take another year, for example, the year 2021, you realize that fine wine investments guarantee you a return on investment of about 20% every year on average. I think you've just fallen across an investment opportunity which is not known by a great amount of people, but which has a tremendously great potential. That's why we're going to be talking about this in the next videos to come. By the way, we are preparing a course on this topic. Well, I hope that today's video has given you the opportunity to avoid fatal mistakes in the passive investments that might ruin your financial life. Like the video, please write in the comments if you would like more and more such videos so that we know how to prepare important topics for you. I give you a rendezvous in my next videos. Till then, ciao.